Thank you for the opportunity to come along and speak. My presentation is probably going to be the shortest one you'll have today, and I hope the most easy to understand. I'm not a scientist. I'm not an insurer. I always like to get that one out in front in case anybody has got a concealed weapon. I come from the Defence Force and then from Qantas, and I guess my background is as a disaster manager, the sort of job where no one likes getting a phone call from you. But more importantly, I've been in the insurance industry now for 7 years. I came to the industry with many of the same, urban myths that probably most of you have got about insurers, but I've yet to see them really do the wrong thing. They tend to run at these situations with bags of money to help people get back on their feet. That being said, there are some really intractable issues, and I'm going to run through some of them today for you. This is a presentation that we give to new members of Parliament, generally. I usually do an MP check before we kick off, but we haven't got any, have we? I can speak freely then. It runs through a raft of issues with that. Let's get this back on track. About insurance, the main topical things that are going on. There we go. So I'm going to cover premiums. How are they calculated? Now, at the end of it, I hope that you'll be able to understand how your particular premium might be calculated and what are the uncertainties with it. I want to talk about very quickly what are the factors that are driving those increases, the increases that you would have seen year in, year out down here, some of them quite sharp depending on where you live. I'm not going to cover the second 2 points just in the interest of time, but certainly we'll see what we can pick up in questions. So premiums, how are they calculated? Let's see if we can go to here. The first thing you have to keep in mind with insurance is that we come at the end of the risk management spectrum. We don't mitigate your risk. We don't do anything other than calculate what might happen to your property and what might it cost to repair it if that happens. So we rely on how resilient is the building. We look at what is it made of, how's it been constructed, how old is it, factors like that. Where is it located? So is the land use where you're situated appropriate for a residential dwelling? And lastly, hazard mitigation. Has there been anything done around the property or in the district to lower the risk of it occurring? Now, if those three things are in balance and are done correctly, the residual risk to your property is kept low, and that means that your insurance premium should be relatively low unless you're insuring a $20 million property. So long-term insurability is all about getting those three things in balance. Who's responsible for that? Poor old local government. Now, 5 years ago, I never said the words poor old local government, but I've come to realise that they're shafted with absolutely everything by every government in Australia. They've really got some hard choices on their hands when it comes to planning. So how's a premium calculated? 2 slides here. First one's for 2009. The second one is a 2013 example. And I want to show you how a premium's calculated and what's changed in the last couple of years. So very quickly, the first thing that's calculated in a premium is the risks. We look at the natural hazards as well as theft and other issues that might occur at your exact location. For many things these days, we calculate it right down to your address, and there'll be a different set of risk numbers for your property compared to the neighbour just 30 feet to the right. If it's something like theft, we might do that at postcode level because there's no better information. So we look at each one of those risks at your property and we say, what is your property made of? If one of those things occurred, what would it cost us to actually replace your property? But you can see that's really only about 1/3, maybe a bit more than 1/3 of the total costs. After that, the insurers have to put aside capital to meet your claim. To do that, we go to the international market, and the Germans and the Swiss sell us reinsurance, which enables us to pay out all claims should they occur. We then have costs to pay. Just like you've got electricity bills and wages to pay, an insurer does as well. There's a margin. Insurers have to make a profit. Anybody here who's living off their superannuation or are still contributing to it, you're heavily tied up in the insurance industry. Making a profit. And the long-term average is about 7 to 8%. And lastly, tax. Here in New South Wales, you've got around 25 to 30%, depending where you live, tax on top of your premium. So if you buy $100 worth of insurance, you actually have to pay $130. So one thing I really want to draw your attention to here is the blue box down the bottom there, sea level rise. You can see it's not in the list of risks. This land here could be subject to sea level rise in 50 years' time to 10 metres deep. It's not going to affect the insurance policy at all because we don't cover it. We don't factor it into the premium. Let's have a look at 2013. What's changed? The primary thing that's changed is we've introduced a new level of cover, and that's because of government and community pressure to do so, and that's riverine flood risk. And if you live in a flood-prone area, that is going to increase your premium quite considerably. For some people, by many thousands of dollars every year. On top of that, the capital requirements have gone up in Australia. The reinsurers have reassessed Australia. We used to be a very benign, very safe place. We're now not viewed in that same way. For many years, we were 2% of the international market and we were 6 to 7% of international losses. And you don't have to be Warren Buffett or some commercial genius to realise that's no way to make money. So the rates have gone up there. And ultimately, that flows through to you as policyholders. And of course, the costs have stayed about the same, the margins stayed about the same, and the tax, because the tax is charged on the base premium, that's gone up as well. So moving through very quickly, I just wanted to give you a nice example. This one's from Ballina. And just keeping in mind that picture about we've now introduced flood insurance. This is a map showing from the Ballina Council the 1% floodway and the 5%, or the 1 in 100 year flood risk and the 1 in 20 year flood risk. Insurers look at this stuff all around the country in an effort to decide how much they're going to charge you. In some locations, we don't have a map like that. If we don't have a map like that for Ballina, everybody's going to be paying probably close to the maximum allowable there. In this case, the way it would work out, and these are very much average, it'd be about $1,200 for somebody outside of the flood zones there. For somebody inside the flood zones, and if that chap rang me and said, oh my God, look what they're asking me to pay, I would say, pay it. That's actually a really good price for a 5% flood risk. And if you sit down with a calculator, you can work out how you get to 5% probability of that occurring in a year. So that's roughly how it works. I know people in Queensland who have got a 10% flood risk, but they still choose to live there, even though their premium's up around the $15,000 mark. So there's very much about understanding your risk, then making a decision whether it's worthwhile still living there. Moving very quickly, because I know I'm going to get the wrap up here shortly. So through an insurer's eyes, I like these pictures because it really says what we're talking about and what our view of climate change is. The biggest factor that influences changes to premiums is what we're building and where we're building it, how much it'll cost to replace. So if you think about the Gold Coast in the 1930s, there was nothing there except probably a beach shack or two and the odd dirt road. If a cyclone at Category 5 came through there, we'd probably be lucky if it was ever recorded. Nowadays, same location, same cyclone would cause multi-billion dollars worth of damage. And that's the fundamental difference. We are building more things in more risky locations, and we're not building in resilience to these weather events, and we're not mitigating against it. So some of the things we're doing about it, we're working with local councils, primarily outside of New South Wales, but we're starting to work here in New South Wales as well, to build resilience heat maps of every local council area. So up in this picture you can see red dots, green dots, yellow dots. The green dots are areas where the insurance industry or actual houses would consider that the house has been built appropriately for the hazards that exist there today. Not in 50 years' time, not in 100 years' time, we don't care about that. How would they fare if some of those events occurred today? The red dots are where we would consider the house is not appropriate for that location anymore, and you might find that the premiums are measurably higher there. If you look at that in a sort of a very fine-tuned scale, this image really says everything. This is up in Dora Creek in Lake Macquarie. You can see the older house on the left scores very, very low because obviously it's subject to a great deal of flood risk and it's been built in a way that makes it very brittle to that. So 1 in 20 years it's going to flood to a metre deep. A metre deep of flooding on that is about $100,000 worth of damage. $100,000 divided by 5, you start getting a very, very high premium. Whereas the house on the right scores really well. Why? Because council did the hard yards and started making people adhere to a set of what might have been considered strict development controls at the outset, but in the long term they turn out to be quite smart because that house is going to be relatively cheap to insure. 5. So that is actually the end. So we've covered how a premium's calculated, what are driving the increases. I haven't covered the second two, but I'm more than happy to take some questions after the next speaker around those things. I do apologise for going through that really quick, but it was emphasised several times, her focus on time. So we don't want to do questions now, we'll do it after. Okay, great. Thank you.